Corporate finance practice problem using Excel. Stock split and stock dividend. Get ready. It's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side, populating that into the blue area on the right-hand side, working a 2-for-1 stock split and 10% stock dividend. Information on the left is going to be our financial statement, our balance sheet. And so we're focusing in on the equity section down here, but we want to look at it in alignment with the entire balance sheet so we get a good idea of what is happening. So remember, of course, the balance sheet in general, we've got our assets up top, liabilities, the debt, that's what we owe to third parties. You could think of it as assets minus liabilities equaling the total equity down here. This is going to be the total equity, kind of the book value of the company. And also thinking of it as the claim of the owners to the assets of the company as opposed to the claims of the liability debtors, the third party, to the claim of the assets. Now, the reason it's a little confusing down here is that the equity in whole, in general, will be the same no matter what type of entity you're talking about. But then when you talk about different types of entities, sole proprietorship, partnership, and a corporation, then it can be broken out a little bit differently. For a partnership, of course, you have the different partners here that'll be broken out. When you're thinking about a corporation, the point of the corporation is that you've standardized units of the corporation, not having then to list the owners of the corporations as individual owner capital accounts, but rather they're all, have an equal share in some way of whatever component that is on the equity section. So therefore, we have then the issuance or the common stock on the books here, and the common stock being listed as how many units, kind of like almost currency units out there of the 100,000 shares in this case at the par value, which remember is a generic kind of number here. We just made up a par value that's going to be less than generally the market value so that we can see a nice even number for the common stocks. And then anything that it was sold for over and above the par value is what we call the capital in excess of par. So these two numbers here represent, in essence, the owner's investment, which was a result from the company issuing stocks and receiving money for that issuance of the stock. Then we have the retained earnings, which represents all the income that has been generated on the income statement over the life of the company that has not yet been distributed out to the owners in the form of dividends. So if you have a dividend that's going to take place, you would think it has to come out of retained earnings, not out of this component, not out of the capital on the common stock. Because if it did come out of the common stock, then it would be an issuance of the investment. It wouldn't be income that's being distributed and could have different impacts, especially for taxes. So that's going to be how it kind of lines up. Now you can think about the equity section as these two components, in essence, the investment, the common stock versus the retained earnings, the earnings that have accumulated and have not been distributed. And you can think of it as on a per unit basis, basically dividing those numbers out by the actual shares that are out there and picking that up. So then we also have the stock price. Remember that the stock price is not something that is driven by the company itself. It's driven by the market. If it's a publicly traded company, then it's going to be something easily known. We're going to look at a 2-for-1 stock split and a stock dividend. So we'll go over here. I don't need this down here. I don't think we need this. So I'm going to go ahead and enter this whole thing as if we had a 2-for-1 stock split. And that's going to be a lot of formatting because this takes place on the equity side. But I think it's useful to just redo the entire balance sheet so that we see it in alignment with the entire balance sheet. So I'm just going to copy over the assets and the liabilities, and I'm going to do it this way. I'm just going to say this equals the assets. And I'm just going to then autofill that down, put our cursor on the autofill handle. Let's autofill that on down to here. And then I'm going to do our indentations, making it look nice and neat. So I'm going to go up top, alignment and indent. And I'm going to indent it this way. I'm going to go to the total. I'm going to indent that again here. I'm going to do that here too, because that one I think should be indented. And so there we have it. And then we'll pick up the numbers, which is going to be actually we'll put it in the outer column here. So we're going to pick up the numbers, which is going to be the 35,000. I'm going to simply autofill that down, putting our cursor on it, grabbing the fill handle, dragging it on down. Let's go ahead and underline it here. Now, I'm not going to pull this one over from here because I'd rather sum it up. This helps me to kind of double check when I'm doing this kind of work. So I'll just sum it up on this side. Equals the SUM, same number, so everything looks like it's working as it should. Let's pick up the liabilities. Just going to equal out the liabilities here. Copy that on down. Autofill that one on down. Indent well, I think I need one more here. One more. Copy it one more down. Let's indent these three, selecting them, alignment, indent. Select this guy here, this girl, this person, this cell, and then we're gonna pull over the numbers. So there we have that. I'll just pull them over one at a time. Let's underline it, and then again, I like to sum it up separately, so it equals the SUM of those two. There we have that. Then we'll pick up the equity side of things. They go to equity side and copy that on down. Copy it on down. So there we have it. And let's indent these, similar indentations. I'll setting them up, indent here, and then it looks like we indented these, alignment indent there, and then it looks like this one's okay. Let's indent this one again, indent that one, okay? And then the shares, we'll pick this up. I'm gonna pull this into the inside because that's how it is on our problem. So 100,000 times 2, this is where our focus is. I'm gonna underline this, 100,000 shares times the par value, which is an arbitrary number. That's not what we sold them for, but that's just an arbitrary number. That helps us to see this number as a nice even number based on the par value, and that can help us just to see that and know how many shares are out there pretty quickly. And then, actually, that should have gone up here, though. This times this, and then we've got the capital in excess. So this is how much we issued them for from the corporation, not amongst themselves, but from the corporation in excess of the par. So this is how much we got for the issuance of that 100 shares, that 300,000. And then the retained earnings representing the earnings that we have generated that have not yet been distributed, but retained, have not been distributed in the form of dividends. And then we could say that the total equity then is going to be the sum of those three, summing those up, and then we'll pick up our total liabilities and equity, and I'm going to calculate that as the total liabilities up top plus the equity down below, and of course we should be in balance for those two. So now I'm going to make an adjustment. I'm going to say, okay, there's a 2-for-1 stock split. Well, what's that going to do then? Well, these shares then, if I'm going to highlight these, this is our focus, these shares have to double, so it's going to be equal to this times 2, and that would generally be the 200,000, and then basically the par value, you would think we would take that down to 1, right? So now we're going to take the par value divided by 2, and that would give us our 200,000. So you'll see here, this should give us the same basically result. This is on the bookkeeping side of things, where we now have the 200,000 shares out there, because everybody that had a share before now has 2 that we're imagining. But the par value we're saying is going to be 1 instead of 2, meaning that we end up with the same common stock value of the 200,000. And so you would imagine then that everybody that has 1 now has 2 shares, but in general, with regards to the book value here for the common stock, they are now worth less. Now, you would imagine that that would generally be the case with regards to the price. You would think as well, although the price is determined by the market, of course, but you would imagine then the market reflects that within the price in a similar fashion, now having 2 shares out there at basically half the price, which could be one of the reasons to have, in essence, a stock split, possibly bringing the stock down to a range that maybe is more affordable to more people and possibly more marketable of a stock in that case. Now let's take a look at one where we have a stock dividend. So I'm going to do the same thing. I'm going to do the same thing this time. Let's do it this way. I'm going to do it quicker. I'm going to say this equals the assets. I'm going to pull that on down here. I'm going to pull that on down here. And this time, let's pull this all the way down. I'm going to pull this all the way down. And then I'm going to use my formatting. So before pulling the numbers in, I'm going to select just this column, and then go to the Home tab, Clipboard, Format Painter it, and then put that in place here. So now we have the Format Painter, and we painted that in. Let's bring in the numbers in a similar fashion. We've got the cash. I'm going to copy that down. This time I'm going to say Control-C, holding down Control and down again, Control-V, underlining here, font group and underline. Then I'm going to sum it up, equals the SUM of these 3 numbers. There we have that. Then we'll pull in the accounts payable and the notes payable, underlining there, font group and underline, and then sum that up, equals the SUM of those items. We'll pull in the equity, which is going to be then I'm going to pull this into the inside, the 200,000. Now I'm going to bring this back to the original numbers. We're back at our starting point, the 100,000 and the 2. So we're back. I'm going to multiply that out in the outer column, 100,000 times 2. The capital in excess of capital, we're going to say that was the 100. And then the retained earnings, we said that was the 687 equals the sum of the equity, summing up the equity, underlining here. And then I'm going to say the total liabilities and equity are here. Now, that's our starting point. Now, of course, our focus is once again in this area. So there's going to be where our focus is. And what's going to happen with this 2-for-1 or this 10% stock dividend? Let's do the calculations on the right, and then we'll populate them back into our equity section, see what happens. So, and again, you would think that the assets and liabilities haven't changed generally. The items that are going to take effect, impacted, are in the equity section. So the number of shares, let's say the number of shares outstanding, we can start off. We know that that started at, and I can't pull this number because we're going to change it. So I'm going to pull the number over here. Our starting point is the 100,000. That's where we started. And then we have the dividends. The dividends percent. The dividend percent is going to be the 10% that we're going to be issuing out. It's the stock dividend. So we're going to say, let's go and percentize that. And let's underline it, font group and underline. And this is going to be the number of new shares. So if we have a 10% stock dividend, we're going to have 100,000 times 10%, giving us 10,000 new shares. So what's going to be the number of shares outstanding once we're done with this? It's going to be then the original number of shares of the 100,000 plus the new shares we're going to issue, which of course are the 10,000, underlining that, font group and underline. So the number of common shares after div, let's call it, is going to be equals the sum of these two, or 110,000. So 110,000 shares out there. So let's think about, okay, well, what's going to be the common stock value? So if we look at the common stock value, we've got the number of common stock. Let's pick that up here. So the number of common stock is now going to be equal to 110. And we had the par value, which we're not going to change here, is at the, and this is different here. So we're going to say we're going to pick up the same number, the 2 here, but so now we have a different number of common shares after the dividend has gone out, and now we have the 2 at the par value, which did not change, and that's going to give us our common stock value, which is going to be equal to the 110,000 times 2, or the 220,000. So now we have, now you note there can't be a change in the ending result here. So there's going to have to be another kind of adjustment so that we're still in value, in balance in the equity section without adjusting basically the assets or the liabilities, right? So just from a bookkeeping standpoint. So let's think about, now we want to think about the capital in excess of par. So we're going to say, all right, the market price we'll say is $12, and we're going to say that the par value is going to be the $2, equals the $2. And so we have that difference. I'm going to go ahead and say font group and underline, and this is going to give us, I'll just call it the difference, and that's going to be equal to the 12 minus the 2, or the $10. Now we're going to take that 10 and we're going to multiply it by the number of new shares, which we calculated up top. So the new shares that are going out are at the 10,000. So 10,000 new shares we calculated up top going out. So now we're going to have the increase in, I'm going to say increase, call it increase in the capital excess of par, which will be equal to, then we're taking the 10 new shares times the number of new shares. Let's go ahead and underline that, font group and underline. And so we get the 100,000. Then we're going to have the original balance, which was in there, we had in there before, the capital in excess of par we had before, 100,000. So now we have in there, we've got the capital in, let's say in excess of par is going to be equal to the sum of 200,000. So we're going to have this adjustment to the capital, because remember what happens down here on these two items. This first one represents, let's go ahead and underline this one here. this first one represents just the par value at that arbitrary number. Now we issue new stock but with a value that has a market value higher than that 2. So we're going to increase the capital in excess of par for that change. And then the difference is going to have to make an adjustment to the retained earnings. We're going to have the difference come into a retained earnings, which is kind of what you would expect because we're taking the value out of the company in essence and giving it to the stockholders, which is a dividend and, a kind of dividend value coming out of the company, which should come out of the retained earnings, just like it would for a cash dividend. So what's going to have to happen for the to the retained earnings in essence to keep us back in balance once we make these changes? So we're going to say, all right, well, the starting balance, which I'm going to pull from the retained earnings in our original worksheet, is here. And then we've got the number of new shares that were issued. The number of new shares, which we said was the 10,000. And then the market price was the $12 on the market price. So hold on. So let's call it market price, which is equal to the $12. And so that's going to be, then let's underline that, font group and underline. That's going to give us our change in retained earnings, we'll call it, because that's the value we're basically giving out here for those 10,000 shares at the market price of the $12. So 10,000 times the 12, that's going to give us our 120,000. So our ending retained earnings is going to be equal to the beginning retained earnings minus the value that we issued out. Just like if we issued out, like dividends in terms of cash. So the ending retained earnings goes down. We're going to go to the font group and underline it. So now let's go ahead and plug these numbers into our balance sheet and see if we still end up with something that would be in balance, right? So we're going to say the number of shares that are now outstanding are at the 110,000. The par value is still 2, so that's going to give us then our 220,000, which matches what we calculated our common stock to be over here. We said that the capital in excess of par should now be at the 200,000. So we got the 200,000 capital in excess of par for the 200, and then the retained earnings now we decreased by that 120. So this is going to be equal to what we think the retained earnings should now be, the 567,000. And there we have it. We're still in balance, you can see here, meaning the total assets still matching up the liabilities and the equity. So one way you might think about this is to first think about the retained earnings. Just to recap this, you might say, okay, the retained earnings, what we're giving out of retained earnings is the value of the stock, which would be the 10,000 times the $12 market price. So we've reduced the retained earnings by the 120 to this 567,000. Then we have to basically do something to these two items in order to be back in balance. We're going to represent the 10,000 new shares is now included in the number of shares now. The par value, which is the arbitrary number, is 2. So we're taking care of 2 of that 12 market value when we have the adjustment just related to the par value. And then the difference being the other 10, the market value minus the par value, is the other 10 that is needed to basically reconcile to balance. And that's going to be that 10 times the 10,000. That's going to be the adjustment to the capital in excess of par. So you can kind of mold this over a couple different ways, but the ending result, of course, is going to be that we have the same amount of assets, the same amount of liabilities. There's going to be a change that happens to the equity section, which in general leaves us with the same ending point in equity. But the distribution, when you start breaking this down on a per share type of basis and what happens to individual holders and whatnot, is another factor that you could basically drill down on. You could look at it in aggregate in terms of equity as a whole, same, but then you drill down on the details and see, okay, what's that's going to have an impact on the individual market price and the dividends per share and all that kind of ratios within basically equity section type of calculations, ownership per unit per share.